A fund can pay you every month, rise in price, and still leave one uncomfortable question on the examination table. Where did the cash actually come from? SPHD has delivered more than its launch period payouts while its share value also moved higher. That sounds healthy, but this is income autopsy, so we are not stopping at the pulse. We are opening the machine to see whether the income came from durable businesses, financial engineering, the investor's own capital, or some mixture of all three. Today, we are dissecting the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD, using data through August 11, 2026. The basic pitch is elegantly simple. Start inside the S&P 500, look for stocks with high dividend yields, then favor the least volatile members of that group. The result is a large value equity portfolio designed for investors who want more cash flow and a calmer ride than a plain market cap-weighted position might provide. But high dividend and low volatility are two separate filters, not a force field. A stock can offer a high yield because its business is dependable or because its price has fallen and the market smells trouble. Low past volatility can identify stability, but it can also concentrate the portfolio in mature, slower-growing industries. And the supplied strategy description adds an options income component, which means the payout story is not limited to dividends received from companies. This fund is selecting income-oriented stocks and using an income manufacturing layer around that exposure. The attraction is cash now. The bill can arrive through restrained upside, pressure on the portfolio's value, or distributions that are not entirely fresh economic profit. That is the real examination today, not whether SPHD sends cash because it clearly does, but whether the whole body has grown after sending it. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold SPHD or any other security. ETFs can lose value, distributions can change, and tax treatment can vary by investor and account. Verify the current prospectus, holdings, distribution notices, tax documents, and other official fund materials for yourself, and consult a qualified professional who understands your circumstances before making a decision. Let's check the vitals. SPHD launched on October 18, 2012, and is issued by Invesco. It sits in the large value category and follows the S&P 500 Low Volatility High Dividend Index. This is equity exposure, not a bond substitute, and not a cash account wearing an ETF costume. The fund has $3,430 million in assets under management. That scale suggests this is not an obscure laboratory experiment waiting for its first investors. Its expense ratio is 0.30%, and it pays monthly. Monthly frequency can be convenient for budgeting, but the calendar does not create return. 12 envelopes do not automatically contain more money than 4 envelopes. Its current net asset value and price are $52.50. That is the market's present value for one share of the portfolio, while the fund's underlying assets provide the accounting foundation beneath it. For an income investor, both parts matter: the cash leaving the fund and the value remaining behind. The honest number to lead with is the current run rate, 5%. That takes the latest 4 payments and annualizes them, answering the practical question, what would a buyer collect if those recent payments repeated? The trailing 12-month yield is also 5%, and the mechanical annualized rate based only on the latest payment is 5% as well. That agreement is useful. There is no stale, oversized historical yield being waved around while the recent checks tell a different story. The latest distribution was 21 cents per share. That is cash, not a percentage, and it should be judged alongside the capital required to own the share and the durability of the source. A 5% run rate is meaningful, but it is not some physics-defying jackpot. It belongs in a conversation about income-oriented equities, not miracle money. If comparable stock exposure rallies sharply, a holder must consider the growth surrendered in exchange for this design. If markets weaken, the cash can soften the experience without guaranteeing protection. Yield is compensation for accepting a particular collection of risks. It is not a coupon stamped by the government. Time for the history. The first 4 distributions averaged 13 cents per share. The latest 4 averaged 21 cents. The direction is up, and that deserves clear credit. Recent payouts average 163% of the launch period average. That is not proof that every future payment will rise, and monthly distributions need not move in a straight line. Corporate dividends can be raised, frozen, or cut. Option premium can expand when markets become more volatile and contract when conditions calm. Portfolio turnover can change the mix of cash available for distribution. Tax classifications can also reveal that two checks of equal size did not come from the same economic source. Still, the evidence supplied here does not show a shrinking payout. It shows a fund whose recent distribution level is stronger than its early one, while the present run rate and trailing history are aligned. For investors who use the monthly cash rather than reinvest it, that consistency matters because household planning becomes much harder when a quoted yield depends on payments that vanished months ago. The next step is to avoid confusing a healthier payment history with a guarantee. Distribution policy is an output of the portfolio and its income process. It can respond to dividends, volatility, realized results, and management decisions. Watch the sequence, not one attractive check. Now examine what remained in the body after all that cash left. The launch reference price was $44.41. Today's NAV stands above it, and the NAV return since inception is 18%. That positive path matters because an income fund can create the illusion of prosperity by paying investors while steadily consuming its own asset base. SPHD's supplied record does not fit that simple decay story. The share value rose over the full period even before adding the distributions back. The path was not smooth. Maximum drawdown was negative 24%. An investor who bought before that decline had to watch roughly a quarter of the position disappear at the worst point before any recovery could repair the damage. Low volatility is relative to the index selection process. It does not mean low anxiety in every market. These are still stocks. Defensive companies can fall when interest rates change, recession fears spread, dividends look vulnerable, or investors suddenly prefer faster growth. There is also a behavioral lesson here. A monthly payment can make a falling account feel productive, but cash arriving during a drawdown does not erase the loss. A retiree spending the distribution while the portfolio is depressed has less capital participating in a rebound than an investor who reinvests. The fund's long-run NAV result is healthy, yet the drawdown shows that the ride still demands an equity investor's stomach. Price alone is only half the autopsy. SPHD has paid $9.30 per share in cash distributions since launch. Add those payments to the share value, change using the supplied simple method, and the distribution-inclusive return since inception is 39%. That result is the central piece of evidence in the case. The fund did not merely move money from one pocket to another while the original investment withered. Both components contributed. Capital remained and appreciated, while cash was delivered along the way. This is also why comparisons must be framed carefully. A plain S&P 500 position is built to capture broad market growth, not to maximize current income or screen for low volatility high yield. SPHD may appeal to someone who values spendable cash and a value tilt, while another investor may prefer a broader fund and manufacture withdrawals by selling shares. Those are different cash flow methods, and the fair comparison is total wealth after fees, taxes, distributions, and sales, not whose account produced the prettiest monthly notification. Reinvestment changes the lived outcome as well. An investor who spent every payment experienced this as income plus a higher remaining share value. Someone who reinvested bought additional shares at different prices and would have a different compounded result. The supplied figure is a simple distribution-inclusive measure, so it is useful without pretending to be a personalized, tax-adjusted performance record. Here is the machine under the hood. The index begins with the S&P 500, then seeks the highest dividend-yielding stocks and selects the least volatile names within that income-oriented group. It weights the result by dividend yield rather than simply allowing the largest companies to dominate. The portfolio's leading positions in the supplied data are Pfizer Inc., ticker PFE at 3%, Verizon Communications Inc., ticker VZ at 3%, Visai Properties Inc., ticker Visai at 3%, the Kraft Heinz Company, ticker KHC at 3%, General Mills Inc., ticker GIS at 3%, and the Clorox Company, ticker CLX at 3%. That list tells a story. The basket leans toward established businesses associated with medicine, communications, property, packaged food, and household staples, not a collection built around the market's fastest-growing glamour companies. Their corporate dividends form one natural stream of cash. The selection rules then aim to combine elevated income with comparatively subdued historical price movement. According to the supplied mechanics, SPHD also uses an options income strategy. In plain English, an options income layer trades some future possibility for cash today. When a fund collects option premium around its equity exposure, the buyer of that option pays for a defined right linked to the underlying basket. That premium can help support distributions. The trade-off is that favorable market movement may not flow through to shareholders as freely as it would in an untouched stock portfolio. You are effectively renting out part of the portfolio's opportunity. Imagine the tech-heavy side of the broad market suddenly surges while mature income stocks rise more slowly. SPHD can lag simply because its index does not own the same mix. If the names in its own basket jump sharply, the option layer can further limit how much of that move is retained, depending on the contracts in force. What should an investor watch from here? First, compare each new payment with the recent sequence. 1 month can be noisy. A rolling group shows whether the income level is truly changing. Second, read the fund's current documents for distribution composition. Separate ordinary dividends, option-related income, realized gains, and return of capital where the reporting allows it. The source matters more than the label monthly. Third, track NAV across full market cycles. If cash keeps arriving while the asset base enters a persistent decline, the health assessment changes. A temporary drawdown is not the same as structural erosion. Fourth, inspect sector and company concentration after index reconstitutions. High-yield screens can drift toward whichever industries are cheapest for uncomfortable reasons. A dividend is only as durable as the business paying it. Fifth, compare the fund with the job you actually need done. Is the goal current spending, smoother behavior, broad long-term growth, or tax efficiency? A good tool can still be wrong for the assignment. Finally, monitor fees, official strategy language, and any change to the index methodology. The portfolio you own tomorrow is determined by rules, not by the reassuring familiarity of yesterday's holdings. Clean bill of health. SPHD earns that assigned verdict because the complete record holds together. The payout is steady by the supplied measures, recent distributions are higher than the launch period level, the share value finished above its starting reference, and the distribution-inclusive result remained positive after the cash left the fund. The best fit is an investor who understands that this is an equity income strategy, not a savings account, and values monthly cash, a large value tilt, and a rules-based preference for higher dividends and lower historical volatility. The trade-off can be worthwhile when dependable income and a less growth-heavy portfolio matter more than capturing every burst of market upside. The diagnosis is positive, not immortal. A future pattern of weakening payments, deteriorating NAV, or distributions unsupported by the portfolio would reopen the case. For now, the patient is doing what an income fund is supposed to do, sending cash out without leaving an empty shell behind. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button, it genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.